The more I talk to U.S. investors, the more I see that the majority, if not all of them, think that things are going to get worse with China before they get better. So again, I think market prices already reflect that expectation to a degree. And I think trade and tariffs get all of the attention, but we have to remember there's this massive fiscal policy wave in the U.S. that's offsetting some of what's going on with tariffs. So you have $200 billion of tax cuts this year. You have $100 billion of additional government spending. You have upwards of maybe $1 trillion of corporate profits being repatriated back to the U.S. So from a fundamental perspective, I think that that's really important to keep in mind. I am a little bit surprised that given we're outside of earnings season, we're not getting this positive news flow that investors can focus on, that they haven't keyed more on the negative trade headlines because earnings have been so critical. But I think they might be looking ahead to third quarter earnings. Expectations still remain really strong, and they're generally just giving the administration the benefit of the doubt that broadly trade seems to be moving in a positive direction, and I'm referring to progress with Mexico and progress with Canada. So I think as long as that continues to be the case, we might not see severe reactions as it relates to China.
What about the latest news, though, Jeff? Not the $200 billion worth of tariffs. That was well telegraphed and the market was expecting it. But the fact that Donald Trump has made very clear that there would be another $257 or $67 billion worth of tariffs put on China if China retaliates, and China did indeed retaliate. You know, we're now talking about close to $500 billion worth of tariffs, or in fact over $500 billion worth of tariffs in total. This is a lot bigger than, you know, when we did see sell-offs in the market based on the trade news. This number's a lot bigger than that one. So I'm struggling to see how it's priced in already.
Yeah, well, I think, look, we're not there yet. I think that's on the table, but we have to react to what we know. And right now, we're not at that point yet. Look, if we end up putting 25% tariffs on $500 billion of exports, that could become an issue. And I think that plays into not only the investor psyche, but what the central bank here is likely to do as well. You know, I think a rate hike is probably baked in for next week. I think December is probably baked in as well, maybe not as guaranteed. But looking out to 2019, I think we have to reassess. Has trade actually impacted the pretty strong growth outlook? We have to take that into consideration, because if it has, then the Fed may actually have to slow down rate hikes. Look, truth be told, the neutral Fed funds interest rate is probably only between 2.5% and 3% right now. So if the Fed's going to hike much beyond that, they have to do so realizing they're going to slow down the economy. And I don't think that that's their intention, especially given that inflation still remains reasonably controlled. So yes, we have to pay attention to it, but I don't want to extrapolate too far into the future just yet, because things can change in the medium term.